Hey there, Singaporean investors. If you're keenly interested in Capitaland Ascendas REIT, A17U, and you're wondering whether to buy more of the stock, or perhaps even consider selling it right now, you are absolutely in the right place. I'm Iggy from the Investing Iguana, and in this video, I will provide you with a candid, balanced breakdown, focusing on 3 compelling good points that make this REIT attractive, and then, just as crucially, 3 significant red flags you absolutely need to be aware of. And make sure to stick with me all the way to the end, because in the final segment, I will give you my personal investment advice on whether to buy, sell, or hold this industrial giant for your portfolio. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We've crossed the 1 million mark for reads, and with over 900 videos and 500,000 watch hours, content is literally all I do. I also focus on regional and global economic trends, giving you that broader context. If you're serious about uncovering the hidden gems and potential pitfalls in the Singapore REIT market, you'll want to hear this. Let's kick things off with the positives. For Capitaland Ascendas REIT, one of the most compelling strengths we've identified is its strategic portfolio transformation towards Singapore's growth sectors. Now, think about it. In Singapore, positioning yourself in the right growth areas often translates to strong long-term returns, especially for CPF investments. The REIT recently completed $700.2 million in acquisitions of 9 Tai Seng Drive, a data center, and 5 Science Park Drive, Shopee's regional headquarters, boosting Singapore's weighting to 67% of the portfolio. This Singapore-centric approach acts like a moat that protects it from foreign exchange volatility and regulatory uncertainty. We've seen this play out with the data center exposure, now growing to approximately 9% of the portfolio, positioning Claire to capture Singapore's booming digital infrastructure demand, which is projected to grow at over 5% annually through 2030. This strategic pivot provides a strong foundation, but is it enough to guarantee future success? Moving on to our second good point, Claire's operational resilience despite challenging market conditions. For many Singaporean investors, consistent performance is key, and this REIT has demonstrated remarkable staying power. Even with occupancy declining to 91.5% in Q1 2025, the trust still achieved an impressive 11% positive rental reversion across its portfolio, with Australia leading at 59% and the US at 10.3%. This isn't just about income. It reflects strong tenant relationships and pricing power that few industrial REITs can match. Consider how this demonstrates Claire's ability to negotiate higher rents even during softer occupancy periods. It's like having the negotiating strength to raise prices when your competitors are struggling. The weighted average lease expiry of 3.8 years also provides income predictability, which is certainly a comforting thought in today's volatile market, isn't it? And finally, the third positive aspect worth highlighting for Capitaland Ascendas REIT is its financial fortress approach to capital management. It's not just about what a REIT owns now, but how well it can fund future growth and weather storms. Claire maintains a healthy aggregate leverage of 38.9%, well below the 50% regulatory limit, providing roughly $4.4 billion in available debt headroom. The trust has also hedged 73.6% of its debt, offering protection against immediate interest rate spikes. These financial metrics are expected to improve as distributable income grew 2.2% year-on-year to $668.8 million in FY 2024, demonstrating the trust's ability to generate cash flow growth despite a challenging rate environment. Are these strong fundamentals truly sustainable, or could hidden pressures emerge? We'll dig deeper into that. Now let's turn our attention to the flip side, the 3 critical red flags you need to consider before making any investment decisions on Capitaland Ascendas REIT. The first significant concern is its declining occupancy performance compared to industrial REIT peers. While growth is good, falling behind your competitors can be a serious burden. The Q1 2025 data reveals Claire's portfolio occupancy of 91.5% trails peers like Fraser's Logistics and Commercial Trust at 94.3% and ESR Logos REIT at 92.3%. This could impact its ability to command premium rents and maintain market leadership if the trend continues. The weakness is particularly pronounced in offshore markets, with Australia dropping to 89.2% occupancy and Singapore falling to 91.6%. primarily due to the dramatic vacancy at the Telepark data center from 99.6% to just 6%. How much market share erosion is too much, and at what point does it become a real threat to shareholder value? Our second red flag is the REIT's increasing sensitivity to interest rate movements. Even with strong fundamentals, rising borrowing costs can erode returns significantly. The proportion of fixed-rate debt coverage decreased to 73.6% from higher levels previously, making CLAR more exposed to rate volatility. Management guidance indicates that a 50 basis point increase in floating rates would reduce distribution per unit by approximately 1.4%, with the average cost of debt at 3.6%. And market expectations for Fed rate cuts becoming more uncertain, this sensitivity represents a meaningful risk to distribution growth. The recent $500 million equity raising at $2.47 per unit also suggests management recognizes that debt financing has become expensive, creating near-term dilution pressure on distributions. It's a classic case of being caught between rising costs and investor expectations. Will the REIT be able to adapt quickly enough? For even more granular data, in-depth charts, and a full written breakdown of CLAR's financials and strategic outlook, make sure to check out our Substack. The link is right there in the description. Finally, the third major concern for Capitaland Ascendas REIT is its premium valuation that limits downside protection. Diversification isn't just for portfolios. It's vital for investment safety margins too. Trading at $2.74 as of July 5th, 2025, CLAR commands approximately a 25% premium to its adjusted NAV of $2.20. This premium has expanded significantly as investors chase yield in a challenging market environment. Historical analysis suggests CLAR has typically traded closer to NAV, or at modest premiums of 5–10%. This concentration of optimism is something Singaporean investors, who often seek stability, must seriously consider. What happens if that optimistic sentiment shifts, or if quarterly results disappoint expectations? These are the questions that keep seasoned REIT investors up at night. All right, we've weighed the good against the bad for Capitaland Ascendas REIT. We've looked at its strategic Singapore pivot and data center exposure, its operational resilience with positive rental reversions, and its solid financial foundation. But we've also squarely faced the challenges: the below-peer occupancy performance, the increased interest rate sensitivity, and the premium valuation that limits safety margins. So what's my overall assessment for Capitaland Ascendas REIT? This is a REIT with a strong legacy and promising long-term positioning, but it's currently navigating some significant headwinds that demand caution from investors. Considering all these factors, my personal rating for Capitaland Ascendas REIT is a hold. My clear justification for this is that while the underlying business fundamentals remain solid with strong sponsor backing and strategic positioning, the expanded valuation premium and below-peer occupancy trends create too much near-term uncertainty for a strong buy recommendation right now. Similarly, its defensive characteristics and Singapore-focused strategy prevent a sell rating, as there's still significant long-term value for patient investors. For Singaporean investors, my strategic advice is this: if you already own Capitaland Ascendas REIT, holding onto your units makes sense if you're invested for the long haul and are comfortable with the identified risks, especially given its dividend yield of approximately 5.3%. However, for those looking to initiate a new position or add to their holdings, I would advise patience. Wait for clearer signs of occupancy stabilization across all markets, or for the valuation premium to narrow below 15% to NAV, around $2.50, before committing new capital. This REIT, while robust, requires careful monitoring in the current interest rate and competitive environment. Is it a good fit for your CPF portfolio? Potentially, but only if you have a very long investment horizon and can stomach the potential short-term volatility. So we've broken down Capitaland Ascendas REIT piece by piece, looking at its strengths and weaknesses, and I've given you my personal verdict and strategy advice. If you found this level of in-depth, actionable analysis truly valuable, please give this video a like, share it with fellow investors, and subscribe to the Investing Iguana channel so you don't miss our future deep dives. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today.